put the gas pedal and take on that risk.
On the other risk, I'm looking at the public equity, 12 plus 88 equals 100. On the others, doesn't quite add up. What am I missing? The constant is 33%, unexplained is 27, and adjusted R squared.
Yeah, really the two components are is that we have the explained portion, which is adjusted R squared, and if you add the unexplained, that should equal to 100. So the 27 plus the 73 will equal to 100.
Is the constant part of the adjusted R squared, or?
Maybe you'll explain the portion.
What, if you start at the top, you're trying to explain where the volatility of the portfolio comes from.
Okay.
On the bottom, you're able to, so you have 100% of the volatility of the portfolio, right? On the bottom, the variables are explaining either 88 or 73 or 77. And those variables include the 4 to 6 macro factors,
Got it.
plus the constant, which is sort of an unknown. We don't know where it's coming from. So we desire to have the constant, like in the public equity, be 0, because the constant is it has a value, but its volatility is just not it doesn't explain anything. So we can sort of say we don't need to worry about it. And then you can see there's what's left over is what's explained by the 6 risk factors. And this is intuitive on the public equity side because you can see that growth risk, which you would expect public equity to be tilted towards growth type factors, that growth risk is explaining 2/3 of the volatility of your equity portfolio. So that makes intuitive sense. The interesting thing is, oh, by the way, you've got 22% of your risk in the public equity portfolio is being driven by interest rate risk. Did you know that? So it's like not only does your fixed income portfolio have a duration, your public equity portfolio has a duration. You better understand that duration, and maybe you might want to hedge against that duration in your public equity portfolio, and Steve will probably get into more details on that later. Does that help explain the numbers?
The difference between constant and unexplained?
That's a good question, Carolyn, and Steve and I have talked about it a little bit. And like if you look at the fixed income portfolio, you've got the volatility of the constant is at 33%, although the model's still pretty good with an adjusted R squared of 73%. So you sort of take that and go, there's something real in there that's going on. What is it? And that can move around. And when you start seeing that thing move around, that might be a signal that we better start paying deeper attention to our risk management process, because there's something creeping in here that we want to get a handle on.
You're kind of leading into a slide Stephen has coming up, which is, remember how each of those growth factors had 4 or 5 subsets underneath it? Mm-hmm. Those aren't constant. And their effect, like gold price and oil price volatility, the effect they have on the market's concern about inflation changes over time. And that's what makes the constant something they've got to then tear back into to say, well, we assumed this wasn't a very important factor, but right now it's dominating the news. And he's got a slide that'll kind of give you a color picture of how that works.
But the idea that fixed income has over twice the unexplained things going on than stocks seems counterintuitive to me.
One thing I would add, and Michelle will like this, is they often say that fixed income, if you want to know what's going on within the equity market, you start at the fixed income desk. They have a tighter sense on how money flows and what the cost of money is, and that's what drives companies and then stock investors. And so literally physically, I've always sat myself near the fixed income desk rather than the equity desk, because that's kind of the start of where the investment world begins. So if you think about it this way, when you have money and you loan it to somebody, you're really scared. When you buy something, that's usually when you're a little more optimistic and a little more aggressive, and I'm willing to take an even bigger risk. So you want to get to the heart of that, I guess, essence of how you feel about money. And that starts at fixed income and goes out. But I think also we need the leverage and would help a lot. I think explain a little bit of the fixed income factor.
Carolyn, I just want to make a couple comments. This is a snapshot.
Yeah.
So this is as of 6/30 011, or 011, I guess I can say 011, 63011. That constant has moved around. It's been, if we went back and looked, we're going to show you some of that, but we won't show you the fixed income constant and how that's evolved, but it's been lower in the past. So this is really the model as of 630, and it's a model. It's not perfect. We got to understand that. But what this is saying is there's something, our model's not explaining. There's something going on in fixed income right now, which 630.11. That's not a bad. I think that's not a bad finding to arrive at, given what we've been going through.
Here's the practical implications. When interest rates were at 12%, everyone focused in on interest rate risk because it would move. With the long bond at 3 and the 2-year Treasury note at 0, it's going to go 30 basis points is a big move relative. And just like the downgrade, the credit downgrade would have fallen in that constant. It's not something we would have picked up in the model as a perceived risk. And as Alan said, the value of bonds went up on negative news. So.
I'm sorry, Steve. I need to make two more comments. One is, if you go, I just want to clarify Chris's comment a little bit. When you see growth risk, it doesn't really mean if GDP goes up, then then equity portfolio is going to go up. That's not really what it means. It means that uncertainty is quiet. I mean, that's what we're measuring here. We're measuring going back to your comment, Carolyn, about volatility, what we're measuring here is not the level of growth, and we're measuring sort of the path that it's going on. Is it a wild path or is it a smooth path? If it's a smooth path, then equity, there's going to be a lot of, public equity is going to have a lot of exposure to it. If it's a volatile path, then it gets to be a little bit more of an issue. So it's more about the uncertainty and not about the level of the thing that we're trying to draw a linkage to. The other point I want to make, going back to you don't have to go back there, but the slide with the 12 things on there, that's just version 1.0. Okay, these things might not necessarily be locked in, and those variables could change. You could add one here, you could delete one here over time as more research goes into how the models work. And so when you see a constant kind of number at 33%, and if that was going to be sitting there for the next several periods that you're looking at this, and it's still there, then the model, that means you need to add something to the model. We need to figure that out. Is it currency? What is it? So that's a signal for model revision.
Yeah, I just want to make a couple of points and then move on. The thing that we have to remember is that when we build this model, what it's helping us to try to do is identify what are the risk drivers. So, for example, when we look at the results here, and it's a snapshot as of June 30th, it's really going back and it's backward looking. And so we know that over the recent quarter is that half the portfolio is really affected by the growth risk. So what that gives us it gives us the ability to identify and hone in now and figure out really what does growth risk mean? How is it shaped going forward, and how will it impact asset class returns as well as the total portfolio going forward? And the other thing I just want to make is that if you look at the inflation risk and you notice it's 0. So what we're really saying is that for the recent quarter is that really inflation risk really didn't matter. It didn't really affect the portfolio. But we know that going forward, if inflation was to change and start to increase, we know that it'll start to impact the portfolio performance, and then we'll start to see that in our model results. Can you flip to the next slide, please? Okay. This is something that Chris was alluding to earlier, is that when we think about risk factors and we think about the different measures, one of the things that we need to point out is that it's not static. So when we talked about the growth risk factor and 67%, let's say, for equities, we took that snapshot. We know that going forward, maybe more or maybe less, but it's going to change. It's not static over time. And there's going to be certain periods where the model is not going to work well. And so, for example, if you go down and you look at the bottom portion of the graph and you go back to the 2004 through 2007 period, you notice that it represented about 50% roughly. So the model was unable to explain roughly attribute 50% of the performance to some factor. But what Neil said is that what we hope to do over time is that we have the first version we want to try to identify other measures and to see if we can improve the model over time, and so that we can figure out what really is driving the performance. But for the most part, we're at a good start, and it's a good starting point.
I think the other thing is overlay that with my seismograph, because it's almost the same time frame. The period where the risk model couldn't really explain much, there wasn't a lot of risk. In the middle of the decade, we had double-digit returns for almost 5 years in a row, and it worked. And the traditional investment policy works very well during those time periods. It's during the extreme fluctuations on each end of that mosaic that we need to use this tool and then potentially use different things to mitigate those risks that suddenly arise. I think Alan wants to say something.
This dovetails perfectly to the discussion we had earlier about the absolute versus the relative. This is all about absolutely losing money. And how do you manage the portfolio to try to avoid some of that? You can't avoid it completely. And this is the beginning of a process. And 3 years from now, if we're lucky enough to still be here, the three of us, we'll tell you that this has changed 50 or 60 times. Because if anyone really had the answers to this, they wouldn't be sharing it with you. But, and it's just important to recognize that. And this is a tool, and it's going to be an evolutionary tool. But the goal is not to see a 2008, to mitigate that to the extent that the use of information and technology can help you manage that. And my hat's off to these two guys.
Yeah,
So
no
as they're talking
impressive.
with us and presenting this information, a couple of thoughts keep running through my mind. There's a lot of these risks, and I think Neil or Stephen said it, we don't know what they are because they haven't happened yet, so they're not listed. And that this is an evolution, and I guess one of the risks is these extreme events, will they happen more frequently going forward, right? And then the third thought that I continue to think about is the fact that this may not necessarily be the solution, but raising our awareness and the fact that we're thinking about it and talking about it and studying it, and the staff is looking at it, and our consultants are looking at all these risks, is from my perspective, important. And as a board, we made this our top priority last year, that we want to raise our consciousness and awareness about the risks that we're taking within our portfolio and better understand those. So to the extent that we're doing that, I think we're making progress, significant progress.
And the important thing to keep in mind, this is a tool and not the tool.
Okay, back to Neil and Stephen.
Can I have the next slide, please? Thank you. Okay, what I want to do now is, I talked about earlier, I want to get inside the toolbox and talk about several tools that we have in place, and then introduce a new tool to you. So the first tool I want to talk about is diversification. And what we mean by diversification is that we're really trying just to improve the risk-return characteristics of the total fund. And there's really, when we look at strategies, what we're trying to do is, number one, either try to increase the expected return and then try to keep the risk level at the same level. Or number two is to keep the expected return at the same, but then lower the risk. Either objective, if we accomplish either one of the two, then we're able to improve the risk-return characteristics. One of the things that, as we look into our portfolio, what we're trying to do now is look beyond the asset classes, and what the tools will give us to do is, if I can use the analogy of an onion, and we know we can start to peel away the skin on the onion and really get down to and look inside of the onion. Then we get, and if you could take that into a portfolio context and look at the asset classes, what we're really trying to do is look down within the asset class, understand what the factors are that are driving to performance. Then we want to compare essentially one asset classes versus another. And we'll see that there's some commonality with respects to factors that are driving, but then we'll see other factors that are sort of maybe unique to that asset class. Then as we begin to, then the goal is that as we begin to understand what factors are really driving the various asset classes, And then we can go back and we can look over history and we can understand that, okay, if these factors are present, how did it behave during a bear market regime? How did it behave during a market correction, during different types of events? Then we might begin to understand what could potentially happen in the future if these events start to unfold in front of us. So as we're thinking about diversification, one of the things that we're trying to do is that we're trying to think about the equity premium that's embedded in our portfolio. How can we diversify away from there? And when we mean diversify away from equity premium, what we're really concerned about is that because we have this exposure to equity and we know that in a turbulent market period that there's a big drawdown in equities. So can we find other assets that have performance similar to equities, but that when it comes to a market turmoil, that it doesn't correlate well with equities. It actually has a negative correlation or low correlation. So what we've done is that, to your credit, is that we have a couple things going on. We have an innovation program. And so our main charge in the innovation program is to seek out and search and research new opportunities that will help diversify the portfolio. And then we have the ER committee. And after the 2008 credit crisis, we came to you and suggested that we form this committee. And the idea was to look at distressed opportunities so that we can invest in it, and once the equity market recover, that these assets will perform well.
Steve, just can I make one quick comment? So just a sort of an anecdotal comment is typically people in my position, practitioners reporting into you, you might even be concerned about diversifying away from the equity premium because that's where the money is supposed to be made, right? But I just want to highlight, it just goes back to Alan's comments, I think talking about your expected return and the downward pressure is, you could almost say, what equity premium? Where's it been? And we don't really know, we don't even, I think it's right now, we don't have a clue as if there's going to be an equity premium going forward the next 5 years. It's just extremely difficult to know that. So diversifying away from the equity premium might, at the margin, if you want to call it that, might be okay. From a, if you move your portfolio away from equities, will you still get the same return you did or you were hoping to get? But it's been a real challenge for the equities even to produce a premium.
Okay, can we go to the next slide, please? The next tool that we have in the toolbox is when we talk about the rebalancing bands. And so what you have reflected on this slide here is our approved asset classes, and this is reflected in our strategic asset allocation. And then the column in the middle is the rebalancing bands. So this is what's currently in place right now. So essentially across all the asset classes, with the exception of the global equities, we have a band of plus or minus 3%. And within the global equity space, it's plus or minus 6%. So what we did was that we talked to some of our peers and we looked across the space in the institutional space. What we really found is that when we talk about rebalancing bands, the bands are typically plus or minus 3 to plus or minus 6, so within this range. So we're well on the low end of the range. What we're going to bring to you is a proposal for your consideration is that we create another policy or another set of rebalancing bands. So in essence, when the market is turbulent, and is that we have more freedom in the portfolio in terms of rebalancing. And so we'll address that at the next presentation. Can I have the next slide, please?
And as you're going to the next slide, I think just the notion of turbulence is something that's got to be talked about. But you want to really have those bands in place when you think the markets are going to become turbulent. You don't want to be putting the bands in place when the markets are turbulent. It's when you think they're going to become turbulent. That's important.
And so that goes back to our risk management framework. What we're really trying to do is to be forward-looking and then try to be develop early warning indicators so that we can act before actually the storm is upon us. So why consider hedging? I found this slide and it's very interesting. Is that this piece of research, what they did was they looked at the Dow Jones Industrial Average from the 1900s through June of 2011. And what they did was they went back and they tried to identify what were the market corrections and what were the bear markets. Again, a market correction is that when the equity market is down 10% or more. And then when we think about a bear market, by definition, is down 20% or more. And so what they found is that in terms of market corrections and bear markets, there were actually 35 over this period of time. So roughly over the last 111 years, roughly about 35 times. So roughly every 3.18 years, there's going to be some type of either a correction or a bear market. I'm not saying that this is going forward, but this is what has happened historically. And so it goes to the point that we talked about earlier. At times, it's very difficult to even predict or even forecast when a correction or when a bear market will occur. So the argument is that since we can't predict, then we should have a tool to hedge out that risk. So to the respect that at some point in the future that we become uncomfortable with the market environment and that we perceive that there's a high probability that a market correction or bear market could occur, we put on this hedge. So.
Are we talking about that wider spread, or are we talking about a real hedge, buying insurance or something?
It's the latter. Okay.
Okay.
I mean, you ask a good question, Carolyn.
Who's going to sell it?
Well, you ask a good question, Carolyn, and there's Steve's talking about explicit hedging, so where you're actually, in a sense, going out and buying an insurance policy against some event, whether it's in the market or not. But that's
selling that stuff.
You can buy it and you can sell it. It's out there in the markets.
I understand currency hedging.
Listed.
I understand currency hedging, but you think there's going to be hedging for global equities?
Yes, it's an ongoing activity. It's huge. It's a huge market. It's out there. But I just wanted to go to your point about the
risk.
I just wanted to go to your point about your bands.
Thank you.
And one way to hedge is to retreat from the class,
Right.
which is what the bands allow you to do.
Right.
What Steve's talking about is taking on explicit hedges, actually going out and buying the insurance policies. That's sort of a different approach. So there are two approaches there,
Right.
and they both do the same thing.
And so sometime, probably not today, but November, something, you're going to explain the hedging to us, how much it costs, who sells it, AIG, whoever who sells it.
That's right.
Yeah, so going back to Neil's point, the first tool that we talked about for your consideration to modify is just the rebalancing bands. So is that if we're able to widen the rebalancing bands, then we have the ability, when we're uncomfortable with an asset class, to actually physically move out of the asset class. Okay. The second tool that we're talking about is hedging, and I know it's new for the board, so it's something that we'll bring back to you and give you more detail. Now, if we go to the next slide, and I want to talk a little bit about not necessarily specific hedge strategies, but what we're thinking about in terms of designing a hedge strategy. So there's different factors that we want to consider. Number one is that when we look at a particular hedging strategy, we want to look at the liquidity. So given the size of our portfolio, we want to be able to design a hedging strategy so that if we were to buy the insurance, that we wouldn't impact the market. Second thing is that we want to look at to make sure it provides protection that we expect. And next thing is that we want to look at the cost of carry. So how expensive is this hedge? And then when is it optimal to put on? Next, when we go to the last slide. Okay. I have a last slide here, and I asked Chris permission. He said it was okay. It's pushing the envelope.
I like the gender division.
Yeah.
It's fun.
The whole point of above, and I just want to draw it. This is the last slide. I'm going to draw it to a conclusion. But the whole point I want to make with above, and I wanted to keep it simple, was that we have risk management and investment management. What we found is that when we talked to a lot of our peers, that it really remained two separate functions. And that is a critical, or one of the reasons why we see that risk management has failed, because it remains two separate functions. What we're saying is that it's really important to really marry the two together. And that's what we're attempting to do in our process, is marry the two. And then I just want to conclude by drawing your attention to the bottom. And we talked about risk modeling. And what we're trying to do with risk modeling, again, is to go back and identify what are the factors that are driving the performance in our portfolio. But we realize the risk model on its own is not sufficient. So we want to really monitor on a much more frequent basis all the data points and understand how is that impacting the portfolio. So we want to take all this information from the risk model and the data that we're watching, and we always want to go back and do a lot of scenario analysis and stress testing and ask the question, really, what are the tails, if any, are buried in our portfolio? We want to have advance notice of that.
Is that it, Steve?
Yes.
Okay. Before Jerry, a couple of questions from committee members.
Yeah, questions. First of all, comment. You know, we get such negative press on bureaucracies, and I thought it was just a brilliant idea to form an innovative group that is to help think our way through all of this. And I happen to be a big fan of the members of this group, but this is just what I think this board was looking for, was to be out in front and to use our size in a way that just wasn't, you know, big groupthink. And I'm very impressed, and I can't wait to see the rest of it as it unfolds. So a question. Let's say we come up with what we, CalSTRS together, believe to be a real cutting-edge way of looking at risk and incorporating it into our investment policy, so we're doing this all the right way. And since we put everything out in the interest of transparency for the world to see, how quickly would we be able to make decisions that would cause movement within our own fund and within our own group and whomever else we're going to share this with? And since we, in a little degree, almost have the ability to move some of the markets, particularly when PERS and STRS might act, how are we going to be first out of the gate, and how are we going to make this work for the teachers of California? Or are we going to have someone out there with a faster computer that's used all our public materials to do the same thing?
Yeah, I guess I would say we can't, you know, we're transparent. This is on the internet over the world. But we have our tools. They're going to constantly change. Other people can do the same work. Hedge funds do things differently than us. I don't think we're going to have the problem of somebody trying to front run our strategy or our model, because we're still going to have, it's not going to be a computer pulling triggers. It's going to be human beings using this and making judgments. In terms of how quickly, a live example would be in July, we called a Tactical Asset Allocation Committee meeting. I think I even told you in an email that morning. I said I was going to call one that day, all hands on deck, whoever was there. We made a decision that day. It was not unanimous, it was mixed, but made a decision to hedge $2 billion in equities. And I think the equity desk got that entire trade done. Trish, where are you? What was that? Probably in an hour? Hour and a half, fairly transparently, without the market knowing. It is a huge liquid market. And so we did that using what are called S&P E-mini contracts, not even the main S&P contracts. That was within our policy because we're allowed to hedge within the bands. And remember, I told you we were going from market weight to underweight equities and wanted to stay underweight equity. So we're, you know, that $2 billion helps, but on a $50 billion equity portfolio, can we move the needle doing 5 or 10 billion? That'll be part of the discussion. I know we have priced out in the past actually buying puts on the entire equity portfolio. Then you're talking about 2 to 3% of your return, which is too expensive. But I think as we're discussing, we're talking about hedging on the margins. We are long-term investors. We do need to be exposed. I go back to my word picture. Maybe it's too simplistic, but I always say to the retirees, think of us like a giant cruise ship, and you set the target on the horizon. I warn you about the risks, but one thing is we're big. We're not really nimble. And a retiree once pulled me aside, I think in L.A., probably was a Dodgers fan, pulled me aside and said, cruise ships now have side thrusters and they can move sideways. And I said, that's what we need to build into the portfolio is side thrusters. And that's what this exercise is partly to do. Can we call it right when to move sideways and when to be, but the whole point is to be a little more nimble, less static. And I've told you in the past, over a decade, my frustration has been the fund has always been too susceptible to negative markets and to recessions all the way back to the early 90s. It's been true at CalSTRS. Part of this exercise is to find ways to be a little bit more nimble and hopefully lessen those periods of underperformance. As Alan said, it's all about trying to protect the value and the wealth of the fund. So I think we can do it in size. I think we're developing a tool, a process. We're going to come back to you in November with policies and policy language so it's easy to measure. Internal audits can measure it. You can measure break out the decisions we make, and we can give you information on what the model is telling us so you see it as well as part of your risk package. Where are we in terms of the global risks and how are they changing? And we're going to do it with more education because as we talk about the additional tools, some of them will need policy changes that you need to be appraised of. The teachers are in the back of the room. You hear the dirty word derivatives. It used to be considered a 4-letter word. I'm pretty sure it's longer than that. Maybe the way I spell it, it's 4 words, 4 letters, 4-syllable word. I often said to this board and to other boards, I think it was back in the state of Washington, I brought in a tool called a biscuit joiner. It's a nasty looking little hand tool that you use in woodworking, and it will cut off your fingers if you use it incorrectly. But if you read the instructions, it is a very efficient tool for a woodworker doing a very specific job. And so my analogy there is that derivatives used by people who read the instructions and use them for their exact purpose are a very effective tool for big professional funds like us. They are not useful for people that are amateurs and aren't following along. That's when you have the Orange Counties and the DuPonts and people that have gotten themselves in trouble. So we'll do the education, we'll change the policies, and part of this is all part of that education process. Is this the right thing? And I want to be open and transparent. There are some people who say, no, I'm just going to stay, static, stick to our policy, which works during a lot of the time periods, but doesn't work during the extreme volatility events.
Just a small amount of success in modifying risk over the long range can certainly make a huge difference, and that's wonderfully exciting, and I'm very hopeful. I hope that we can sort of ditch the joiner analogy. One of my beginning teachers had a student who woodworking. This is just last year.
Then I won't use it. I won't even go there.
Student lost a finger in first month the teacher was there. So I understand that one. So let's drop that.
I'll come up with a better one.
The better one.
The bottom line is read the instructions before using it.
Yes, and he certainly didn't. The young man did not. That he will wear that the rest of his life.
Carolyn.
I have a lot of questions about the hedging business that I'm going to hold off until I see your write-up. Let me see if I get this right, though, the big thing you've dealt with today. And again, Neil, Stephen, I found the whole presentation really provocative and exciting, and I want to add my commendation to Geraldine's. But we are going to proceed as though market theory and diversification and asset classes work. We're going to run stochastic things and set our asset allocations, and we're just going to assume that it all works. We're going to overlay that with this risk policy. So paying attention as we get these variables worked out, and literally try to anticipate before we're deep into it when we think we're on the edge of a crisis, at which point we'd have a second policy that would change our ranges and change our hedging on both global equity and fixed income. Is that it?
It would actually, because these global factors across the whole portfolio, we've been sitting with each asset class and looking. Most of the tools, you're correct, are applied to those too. But as Stephen has pointed out,
question's going to be.
As Stephen has pointed out, we're going to think, remember, instead of like other funds where they took their asset classes and they broke them back up among the six, we said, you know what, the world's not that neat. We're going to leave the asset classes alone. These six factors overlay the portfolio.
Okay.
And so if we're worried about one of the factors, we'll hedge that factor across the whole portfolio, recognizing, as they just presented, that risk is somewhat embedded in equity, in private equity, in real estate, in fixed income, and we'll think about that risk comprehensively.
This last one we've been through, if we couldn't have applied it to real estate.
Everything. Right.
And
to back up, the theory is, yes, that our investment policy and our core foundational theories work very well the majority of the time. That bell curve distribution, they work 86% of the time, I'm going to say roughly, very well. But there are extreme tails where they don't work as well. We're not going to try and identify the next crisis. What we're going to try and identify, as they've made clear, is higher uncertainty, that there's more volatility, that there's more uncertainty. And therefore, in my word picture, we're on that cruise ship. There are more storms. There's more uncertainty. We need all hands on deck with more tools and more latitude, potentially. Some cases I know we're going to recommend we batten down the hatches and we reduce our latitude. We lower our discretion levels. And other places we increase our discretion levels. I hope that we're right in protecting ourselves from the next storm, but I also know, as Alan has said, by reducing our risk and actively managing our risk, we will reduce our return a little bit. My example, we will pay a premium, potentially we have to decide, are we willing to pay a premium to avoid that fire insurance, that life insurance? And if Alan came up here before and said, well, you underperformed your peers by 50 basis points, but you should celebrate because you bought insurance and they didn't, you were protected last year, they weren't. You can imagine that'll be hard for boards to get used to, but those are the things that we'll talk about and figure out. But that would be the theory we've come down with, is instead of having one policy try and do everything, you have a standard policy, and then using these risk factors, you shift to different guidelines. That way it's easier to signify the date we move. You can audit to it. You can measure the performance differently. We're heading down that path of thinking that's a more cleaner, efficient way for the board and the public to understand and to go.
the one thing that hasn't been discussed is what you have told us several times about this lost decade. That we still have over 50% of our assets in global equities, and this was a decade that returned zero. So I assume that is the extent of the tail events, how big they were, that they wiped out any gains in between.
Yeah, remember that seismograph I showed you? That middle of that decade, remember, we had double-digit returns year after year after year.
But we are going to continue on with over half that asset class.
Right now, right now, that is the continued discussion, and I think as we get better at using this and understand it, that'll be part of what we have to look at is remember, that would have worked very well in the 80s and the 90s. It suited us extremely well. And we aren't good enough and smart enough to be able to call decades to say this is the 1980s or this is the 1970s.
But you always tell us, though, this last one was the only one where zero return for the whole decade.
This one rivaled the 1930s. Remember, we've gone back to the Civil War and looked at, and the markets don't trade on discrete decades, but we've gone back and looked, and it was that bad. That's to try and help the teachers and the public put it in an order of magnitude, because there's this sudden pension crisis. It didn't just come up in 2008. It's the fact that you had and I think that brings it home, people, you had a decade as bad as the 1930s. What about, the 40s and the 50s? The 50s were the best decade ever. It could, markets can change.
Very short, and I'm beg your indulgence because I have to be in New York in the morning.
Lucky man.
No one knows, Carolyn.
Yeah.
I mean, this is a tool to help you when the world is hard to explain and it isn't obvious. It's going to require your staff and you to take a step back and say, what is going on? And to the extent you don't have a good answer, then it's going to say, let's get more conservative. And it's really no more complicated than that. And it has nothing to do with forecasting the future. It's saying, what's happening today, we have real live inputs. We need to do something about it when we really don't have confidence that we have a sense of what's going on. And it's a tool. It is not the tool, it is a tool for the staff to help talk to you. And with that, I
Thank you.
apologize
So,
for my exit.
If there are no other comments or questions from the committee members, I want to thank the presenters, Stephen and Neil, for your work.
Definitely.
Great presentation, very thoughtful. You're bringing us along quite nicely, keeping us informed on this significant project. Speaking for myself, I anticipate and I'm looking forward to seeing what the policy adjustments that you'll be recommending to us, hopefully some of them in November, in particular the one around the ranges, because I think it's difficult to argue that it would be inappropriate for you to have fewer tools in the toolbox to deal with a world that has become more and more complicated and probably will become more complicated and volatile as we go forward. So from my perspective, this makes a lot of sense, and I think the risk of being wrong and not having these tools in the toolbox may be a risk we can't afford to take, as opposed to, well, if we get a little bit more conservative at certain times and we're wrong, that might be okay. But if we don't have the tools and we can't execute at a time when we need to, and we're wrong, that might be a price we don't want to pay. So thank you.
Thank you.
Okay, so item number 10 is the Chief Investment Officer's report. And before we go to Chris, just for the public's information, there's going to be a reception after our meeting, after we adjourn. We're going to be acknowledging and recognizing one of our current board members and a former board member in the restaurant area of our building down the hall here. So immediately following, all are welcome to join us. Chris.
Thank you. I will try and be very quick. Recognizing the event that's going on and run through all this material as fast as I can for you. It's been a longer meeting than we expected, and I want to finish stronger than I started, that's for sure. And I can't get this to work either. Can you guys go to the next slide? You got it. How'd you do that?
Oh, yeah.
Ah, you did it.
Oh, you did it.
It's got a hole in it. So, okay, there's real life. Yeah.
Very sophisticated.
There we go. So there's the S&P 500 since July 1st. You can see that the month of July we were doing okay treading water, but then the decline. And I have mentioned to you several times, it appears that we're in a trading range of about 1120, 1140 to 1240. We touched the top of that last week. We went near the bottom again 2 days ago, and now we're back near the top again. So we'll see if we're in a new trading range. I'm not as concerned that this is another Lehman event. The Lehman event was really precipitated by a ton of people who couldn't pay their debts. Now, the question is, you've got Greece, Italy. If they can't truly pay their debts, then we have another event. But right now, they're kicking the can down the road and finding ways to pay it off. So we'll see. Where we're at today, we have 147 billion in assets. We're down from that. That's where we were last week. That puts us down just under 5%, less than 5% for fiscal year to date. So as Alan said, it has been a very difficult period. The dark blue bar is June 30, so you can see July and then August 31 values on the fund. Here's the asset allocation. The key is we're being very defensive and continuing to stay defensive within our existing policy. We are near the bottom of the range in equity. We're right at 50%. As we said, that's where we wanted to be. The target's 53. The bottom of the range is 47. So we could be more negative. We're halfway between the target and the bottom of the range. We're also very low in fixed income. We think and still think that's the right place to be. But as you've heard from Alan, the bad news came out and fixed income actually rallied. So we underperformed in our weighting in that area. And we also had bet away from treasuries somewhat, and treasuries rallied on the bad news about them. So that hurt us as well in terms of the performance. So it's starting out the fiscal year very rough. The only positive is there are 10 more months, and we've seen years like this where we stumble in the summer and then come back. So it has been global. The chart there is Germany. So you can see that that chart is very similar to the U.S. chart that I showed you earlier. The U.S. and the U.K. are both down about 8, but Germany and France are the ones that are down the worst because of their banks. The fear that their banks own too much Greek and Italian debt, and that if they don't pay, then the banks will suffer. Some of the bank stocks, even in the U.S., have fallen 50% in value in just this year. Some bank stocks, if you've heard the anecdote, Apple has enough cash to buy entire banks outright and own companies. So what's coming up in the future? We'll have a 2-day meeting of the Federal Open Market Committee. The market has a lot of expectations that something special might happen after that. Normally they have a 1-day meeting, but they expanded it to 2 so they could talk more about the market. The big focus, as I've told you, is going to be on that Congressional Super Committee, and I've got a slide in here that shows you the time periods involved. And then the debt crisis will continue to loom. Like yesterday, it will pop up on and off at night while we're asleep. Something will happen in Europe, and somebody will say something that will then lead to our market. I'm going to continue to send you statistics mostly on sentiment to try and gauge whether we'll slip into a recession or not. Is really going to come down to how consumers spend or not. As the statistic last week showed you, consumer sentiment went negative, but how people feel doesn't always directly affect how they spend. They might feel bad and then go out to dinner. I'll put in a plug because it's my favorite. My wife will laugh. She knows this. The never-ending pasta bowl at Olive Garden. Half the time you can't get a seat because so many people are going. So they'll feel bad, but they'll treat themselves, and that's what you don't know what the consumer is doing until you see the hard numbers. So here are the upcoming dates for the Super Committee. It's very important, and the reason I use the cute little graphics is just to remind us it's going to take a long time, all the way out to the holiday period before this group is done, and I guarantee you Wall Street will have a conniption fit every time around these dates, positive, negative, and the rhetoric will, I'm sure, drive us crazy. They're supposed to start meeting here mid-month. You get some initial stuff in October. Then really it's Thanksgiving when the most of the stuff comes out. Then we wait till Christmas for even more. And then it's not until New Year's that we really know, did they do anything or not? Are we back to the Tea Party and all that we saw in August? But I think that movie is going to be replayed, I fear.
Chris,
Yeah.
if I could just, if you saw my report tomorrow, we talked about the retirement issues that are already starting to float through the super committee research going on. So just a reminder, in November, I'll have John Stanton on the screen and we can get a upfront and close personal interpretation of what the super committee is doing, particularly on Social Security, Medicare, and the retirement issues, since they are looking at some rather strong proposals in that area that would affect us. So we want to look at that. Thanks.
Here's a positive. This is a slide of mid-year election cycles, which this year we considered being. I know next year would normally be the election cycle. The point is the blue bar is going all the way back to the 30s. Generally, the third year of a president's term was very positive because the president wanted the economy going robustly as they started to hit the campaign trail. And up until about the Reagan years, there used to be very much a group that would publish the presidential cycle. And you sold on Inauguration Day and you bought on Easter a year later. And it worked very effectively through the 70s and into the 80s, but then it has not worked as well. But normally this would be a very positive chance for a good year. But right now, looking out, you know, as we said, the Federal Reserve and Congress right now are out of any gasoline to fan the economy, so we'll see. And then Alan already harped on these, and I just wanted to share them. The risk factors, as we've said, they've got a couple of risks that are at the extreme and fluctuation point. The market volatility, the slope of the yield curve, interest rates being at ridiculous lows, but now we know they're going to stay there for 2 years. So that bar is going to be up in the attention span for 2 years. And that's one of the things we have to be aware of. So looking out on the horizon, what are the risks out there to us? The pigs are going to remain a risk. Jobs, jobs, jobs. Then, you know, obviously, boy, as Michelle coined, a hurricane, an earthquake, and what's next? Locusts. The East Coast has just been under attack. But we have the internet, we have China, we have a beetle. We have algorithmic trading, high-frequency trading to worry about, earthquakes. The litany goes on, but these will sit out there as ulcer-creating problems for us. So where does that lead us? We told you in the 11-12 business plan, and we thought it would be a very tough year. It is proving, sadly, to be true. Income is the key, and that's what we're looking for across the whole portfolio, is coupon income, rental income, infrastructure income. That's going to be the key. And what we're going to come to you and talk to you in the next couple of meetings about are other ways to add more income to the portfolio, such as a covered call program. PCA talked to one of their clients just 2 weeks ago about that idea. That would be adding coupon income to the equity portfolio. We're going to have an infrastructure transaction hopefully in November for you. And then also continuing to be very active in how we manage the asset allocation within our existing policy. So these are all things within the policy. And then I thought I would quote Warren Buffett, the Oracle of Omaha, at the end, which is kind of the contrarian point of view, is to be fearful when others are greedy and be greedy when others are fearful. Right now, the world's very fearful. Warren's trying to be positive. I don't know about greedy. But I think we do have to caution ourselves. Human emotion, you know, 2008 was not that long ago, and so this feels like it. But it may well not be true at all, and we just may weather the hysteria. Don't have high hopes for Europe and for the Congress to work this all out, but I don't think we're necessarily headed for the deep, dark disaster. I think we're just headed for a range-bound market for a period of time and a tough year where I hope we can still squeak out positive return when we're all said and done, but it looks pretty gloomy right now. That's it.
Thank you.
Go party, huh?
Any questions or comments for Chris? Okay, thanks, Chris. Item number 11 is review of information requests. As I recall, there were 2 minor requests for the real estate division that they can forward to us through email, if I recall correctly, and there were no other information requests. Okay? Seeing no other information requests, just take a quick look at the draft agenda for November of 11. Any, yeah, Beth? Sure. See the agenda for November. Any comments on that?
It's really scary.
Seeing none, we'll entertain a motion to adjourn. Okay, we are adjourned. Thank you.